All right, so now right now we start the new standard as 20. As 20 speaks of accounting for government grants and disclosure of government assistance. You know, when you can be doing something in your business, but the government may be somehow involved, right? So if it is somehow involved, maybe there are funds or there are resources that come that flow to you from the government. There can be there can be a lot of things. You could get some assistance. Now you have to know how to distinguish between government assistance and government grant, something like that. We'll see the difference and how to deal with that. That's why you say for government grants, we usually account for that in the books, but the government assistance, we usually just disclose something in the notes and something ends. All right, let's just go forward and take a look at this. So, as I told you, it's common for governments, for entities to receive government grants for various purposes. Maybe you're just helping some people. Maybe you have created employment, and the government tells you that, oh, if you if you are ready to pay maybe $60 million to purchase a certain equipment, then I'll add $20 million for you, provided that you will be hiring some employees for at least 10 years. The government grants you something under the condition if you do fulfill those conditions, right? Okay, so the objective of S20, what is the objective? It's just to prescribe the accounting for and disclosure of government grants and other forms of government assistance, right? Just like that. So what we'll discover, we're just going to cover something. Actually, this standard is short too. Scope. We will cover the following, but also will not cover the following. Maybe let's go and take a look at what this does not cover. You know, when speaking of government grants, you have to know where the scope is limited for IS20, right? There are some other things that you can deem to be the government grants, but they are actually not accounted for in this standard. For example, accounting for government grants in financial statements reflecting the effects of changing prices. So maybe in case of maybe there are price changes, we cannot say, oh, the government has granted us something because the prices have changed. No, it's something like a government comes to you and makes an agreement with you, right? Okay. Uh, Government assistance given in the form of tax breaks. Let's say the government are giving a tax break. Maybe don't pay tax for 6 months or something like that. That one is not accounted for here. Or benefits in determining taxable income or accelerated depreciation allowances or reduced tax rates. Things like this which relate to these matters actually fiscal policies actually would not involve them as far as under IS20, something like that, right? I hope you know about the depreciation allowances. You know, in your books, you may be depreciating something at straight line 20%, but maybe the tax laws may require you to depreciate by 40%, reducing balance, something like that. So that
Yeah,
is
yeah, yeah.
relevant. All right. And so we are told here that the government acting is part owner of the entity. The government is part owner of the entity, and they are saying that it's a government grant. It's obvious that it's not. Just because the government has invested in you, it's not like it's a government grant. And again, you're told here that government grants covered by I-41 agriculture. And this standard actually, we speak of government grants, but it is a very specific standard, so we'll not speak of it here. Actually, there are some matters that can apply here, but some cannot apply. All right, note the following. Just note this. The benefit of a government loan at a below market rate of interest is treated as a government what? Is treated as a government grant. You know, there are situations that maybe the government grants maybe the normal rate is 20%, but maybe you are allowed to borrow at 12%. So you have a benefit of 8%, something like that, right? Okay, let's take a look at the definition now because we have been speaking of government assistance, government grants, but we have not taken a look at the definition. So let's take a look at them and then we can proceed. What is the government? By the government here, that's it's not like this is civics, this is not politics. You just need to know what we mean by the government. That's why you can wonder what I'm writing, what is written here. Government means the government, government agencies, and similar bodies, whether local or national or international. So whatever is directly linked to the government, we call it government by government grant, right? Right? It's a public agency. It has maybe entered with you into an agreement. We say that it's a government grant or bodies of the government. Now let's distinguish between government assistance and government grant. Now, by government assistance, we say that it is an action by the government. The government comes, designs an action to provide an economic benefit to a specific entity. So you get the benefit directly, right? To a specific to an entity or range of entities qualifying under certain criteria. The government comes and says that, oh, all entities may be involving themselves into this particular industry can be entitled to something like this, right? So it's just the benefit that is brought by the government to entities that have already qualified certain criteria. For example, maybe market information from abroad. Maybe you are involving yourself with medicine, and maybe the government brings information about medicine from abroad. Maybe this and this is required. You can produce this, and maybe you can sell at a higher price. Advice on procurement, something like that. You're already entitled to you're already in a particular industry, and the government brings you this information for you. So it's the government assistance. But now, when we speak of the government grants, we mean that it is also government assistance just like this, but it is an assistance by the government, just like above, an assistance by the government in the form of transfers of resources. Now, it is not like you are just brought, just some useful information is brought to you. No, there is an actual transfer of resources, right, to an entity. Now, the government transfers resources to you in return for past or future compliance. So it's not like just a normal system that maybe you are qualifying a certain criteria. No, in return for past or future compliance. Maybe there is something you already did in the past, or maybe you have agreed that you will do in the future with certain conditions relating to the operating activities of the entity. So, simply speaking, for the government grant, it's either that you already met the conditions, or you have to meet the conditions for it to be used. If maybe to meet the condition, you may be told, I've stayed this employee maybe for 3 years. Since it involves the future, the government won't be sure on whether you meet the conditions or not. So it will monitor you. In case you fail, then you have to pay back the grant as appropriate. So that's why I say they exclude those forms of government assistance which cannot reasonably have a value placed upon them. Even before proceeding, this is obvious. you know, Government grants have to be recognized in the books. So if you cannot place the value, how can you record the government grants? So it's obvious. Actually, we would like to record them in the book, but we do not know the value. So if you cannot know the reasonable value, how are you going to do that? Even PPE itself, something can be PPE, but if you cannot measure it reliably, you cannot take it to the financial statement. So it's just something very, very normal. And so we're told that if the value cannot be placed on them and the transaction with the government, which cannot be distinguished from normal trading transactions of the entity. This too is obvious. You are making transactions with the government, but you cannot distinguish them from the normal operations. So to say that it's a government grant is difficult because it's like the government is involving itself then. All right. So after having seen those two definitions, you already have a glimpse of what to expect. All right. Now, maybe we'll see this later, but let's just go through this definition too, because that's what we'll be taking a look. Grants related to assets. Now, I need you to know one thing. Here, we'll be studying about only two forms of grants. Grants related to assets, but also grants related to income. Actually, being more clear, usually when we say grants related to assets, we speak of non-current assets. And any other grants not related to non-current assets are classified as grants related to income. So you need to note that. Actually, everything is ending here. These definitions explain all the standards. So grants related to assets, the government grants whose primary condition. Look, because to have the grant, you have to fulfill the condition. Whose primary condition is that an entity qualifying for them should purchase. See, it's either simply speaking, should acquire, should purchase, construct, or otherwise acquire. just say this. So the main point on grants related to assets is on non-current assets, whether you have purchased, you know yourself, whether you have made self-construction, you know yourself, whether you have acquired in your own way you wish, is all is on your own, right? So subsidiary conditions, that's why you're talking of primary condition, right? But now we say that other conditions, secondary conditions, subsidiary conditions. Subsidiary condition may also be attached restricting the type or location of the asset or the period during which they are to be acquired or held. So if you have a question and you see that there are other conditions like these are just subsidiary conditions. They are not what define on whether the grants are related to assets or income, right? So you just have to be sure of that. All right, now let's go to government grants related to income. This is nothing much. All government grants other than those related to assets. So if there is no relationship with the assets, we say non-current assets, we say that, oh, this is a government grant related to income. Okay, let's go to the last definition, forgivable loans. The definition, the way it speaks of itself, forgivable loans, right? These are loans for which the lender undertakes to waive repayment under certain conditions, right? When you speak of forgivable, it's like someone lent money to you, but maybe right now they forgive you, but they give you condition. Maybe I'm forgiving you, but make sure that you achieve this and this, achieve this and that, something like that. That's what we call forgivable loan. All right. After knowing this, now we can just proceed and now.
I didn't understand this forgivable loans.
All right, forgivable loan. Let's say that you need $10 million and I lend it to you, right?
Yeah.
But maybe after some time I deem it impossible for you to be able to pay that back. And maybe I see that I'm forgiving you, but make sure that you do something. Someone may not be able to pay back something, but they may be have resources to do something which you can consider useful, which you could actually do by having such loan paid back to you, right? So
Okay.
you tell them to actually meet a certain condition, maybe do this and that. By doing that, it's like they are indirectly paying you back. Are we together on
Mm.
that?
Yeah.
All right. Now, let's go to recognition. When dealing with government grants, you have to show them in the books. So, when are you entitled to show to reflect the government grant in your books? That's where we are. So, here we say a government grant is recognized only when there is reasonable assurance that we are speaking of reasonable assurance because, the government grant, for example, I tell you, oh, go and buy this item. It is worth $10 million, but I'll give you $3 million, given that you will stay with these employees for 5 years. How will I know that you will stay with them for 5 years? I won't be sure because the future is uncertain. There are a lot of things in the future. That's why we say only when there is reasonable assurance. It's not real, it's not actually certain, but there is a reasonable assurance that, first of all, now before reading this, just small thing. We'll speak at two conditions, right? We'll speak at the condition of I'll take you at the clinical session. So we'll have to take a look at the two things, right? On the entity side, that will illustrate the grant, but also on the government side. So first, the entity will comply with the conditions attached to the grant. As I told you, the grant has conditions. So if we see that, oh, this we cannot fulfill those conditions, then they're going to recognize the grant because it will obviously have to be paid back. So stop that. But also the grant will be received. So simply speaking, to remember this well, just say that we take a look at the entity side, which is it will fulfill the conditions, but also we take a look at the government side, that the government will give the grant, so the grant will be received just like that. These are the conditions we have to follow. All right. Now, for other explanations, we say here that even if the grant has been received, we say that the grant will be received. All the two conditions, both A and B, have to be met. But maybe it can come that the government has already given you the grant. You already have it. So we are sure that you already have the grant. So only the conditions to be fulfilled remain. But we say, even if the grant has been received, this does not prove that the conditions attached to it will be fulfilled. That's why I do not say that, oh, the government has already paid me. I already have this grant. So do not ignore the part A just because you already have the grant in your pocket, right? You have to consider on whether you'll be able to actually meet the condition. Are we together on that?
Yeah.
All right. Now after that, we say that it makes no difference in the treatment of the grant, whether it is received in cash or given as a reduction in a liability to the government. It doesn't matter, right? The government may give you the grant, may give you cash, maybe take this 10 million and fund your projects, or maybe you owe the government, you have to pay them. You say that, oh, or maybe you as an entity owes $20 million. Do this and maybe your liability will fall from $20 million to $5 million. So that doesn't matter. It makes no difference in the treatment of the grant, right? It will be treated the same way. So the manner, that's why I say the manner of receipt is irrelevant. It doesn't matter how you are going to receive that. Okay, another point. Any related contingent, of course, this is usually not seen, but it's just like you can just do it. Any other I hope you know the meaning of contingent, right? It is future uncertainty. You won't be able to know exactly what will happen. It will depend on the future uncertain events. So any related contingent should be recognized under 37. There's a standard called a 37. It speaks of provisions. Provision is a liability that is probable. Contingent liability, a liability which is possible less than 50%, and contingent asset. This is the standard. So in case there is any contingency, would fall under that. But actually, to meet this is very rare. But just once the grant has been recognized. So when after recognizing the grant, whenever there is something having uncertainty like for provisions or contingent liabilities, you have to apply a 37. Of course, that will show itself in case it happens, but we won't deal with it here. You just need to know the documentation. And now, as for forgivable loans, which we defined earlier, as for forgivable loans from the government, it should be treated in the same way as a government grant, right? So you are being forgiven the loan, you have to do something. You can just treat it the same way as a government grant when it is reasonably assured that the entity will meet the relevant terms of forgiveness. As I told you, you are told that if you hire these employees, I'll forgive your loan. If I forgive your loan, I'll reduce your liability. That's why you can see, I will say that it makes no difference in the treatment of the grant, whether it is either received in cash or given as a reduction in your liability. Maybe the loan has been forgiven, your loan has been forgiven, so the liability is reduced, right? That's why you're speaking as a reduction in liability due to forgivable loans, the component here. Okay, now let's go to this part here. Additionally, right now we have not started actually acting on how to treat. We just need to understand first. The theoretical part is usually very useful because it has some practical elements. So additionally, the grant is recognized as income. Usually, actually, we'll see this. Don't worry about this. We'll see it. The grant is recognized as income over the period necessary to match them with the related costs, for which they are intended to compensate on a systematic basis. What I do mean here is, we'll see this in a computation, don't worry. What I mean here is, let's say that the government has given you $10 million to stay with the employees for 5 years, right? That means we say that I have $10 million, but if you divide it by 5 years, you get $2 million. So each year, I'll be recording an income of 2 million each year, right? Because it should match the cost income. Or maybe you have bought an equipment of 4 years using life, and maybe the government have contributed $10 million. So if you divide it by 4, you get $5 million. So you say that you will be recording that income each year of $5 million, right? Until the
Okay.
useful life of that non-current asset is over. Don't worry about this. We'll see this actually in a practical sense. We'll be solving this. And we are told here that grants should not therefore be credited directly to equity. Of course, you do not take the grants and take them directly to equity. Don't worry about this. There are the accounting approaches. All these are explained down here. You know, if you have the grant, let me tell you one thing. If a shareholder gives you $10 million as the share capital, they obviously go to equity directly the share capital, right?
Mm.
But if the government gives you the grant, you do not take it to equity, to capital directly. That's what we are trying to specify here, right?
Okay.
Yes, that's why there are different approaches, but we usually use only one approach. That's what we'll see down here. Okay, now we are told here that the grant receivable is compensation for cost already incurred. Let's say maybe you already incurred the cost and now the government comes and gives you that. A grant receivable for before reading this, to take a look here, we say that this income recognized should match the cost, right? You see the income you recognize should match the cost. That's why if you have maybe the equipment with 4 year usage life, you have to match those income for 4 years. Maybe you have been told to stay with employees for 5 years. You also have to break down that amount, that grant you are given for 5 years. Now, presume that you have already incurred those costs. You have already incurred the cost and you are receiving the income. If you have already incurred the cost in the past, then or you can also recognize the income directly because the cost you already incurred in the past, right? Are we together?
Yeah.
That's why we say a grant receivable is compensation for already incurred, for cost already incurred. If the cost already incurred, then the income should also be recognized right away. We can say the income recognition should be accelerated. So the cost already incurred or for immediate financial support with no future related costs should be recognized as income in the period in which it is receivable. So you just receive it and you recognize it instantly because its associated costs were already incurred in the past, right?
Okay.
All right. And now
Yeah.
we just need to proceed ourselves now to treat this. A non-monetary asset. Now let's presume we have a non-monetary asset. You know, a monetary asset is like investment in shares, things like that. Or maybe a monetary asset is something for which you are entitled to receive something. For example, trade receivable is a monetary asset because you have sold something to someone and someone has an obligation to pay you back, right? You have
Mm.
sold something and you're entitled to receive something, to receive money from that person. Now, I hope you know the prepayment. Maybe if you have a prepaid rent, if you prepay the rent, it's a prepaid rent. A prepaid rent is like you have already prepaid. You are entitled to receive savings, not money. So a prepaid rent is not a monetary asset. So you need to distinguish monetary asset from non-monetary asset. Or let's say PPE. PPE is not a monetary asset because you can use PPE to generate money, but having PPE doesn't give someone an obligation to pay you. So when someone has an obligation to pay you cash, to pay you money, you can call that a monetary asset, right?
Mm.
Okay, so a non-monetary asset like PPE may be transferred by the government to an entity as a grant. Let's say the government, instead of giving you money, they give you, let's say, a plant. Take this plant and produce, but make sure that you hire at least 50 employees and they stay with you for at least 10 years. So it may be given by the government. For example, a piece of land, let's say, or other resources. Now you see that if the government has given something like that, you need to know its cost. Otherwise, if something is given in cash, the cost is already known. But maybe you are given the plant. How will you determine that cost so as to apply it in the book? The fair value of such an asset is usually assessed, and this is used to account for both the asset and the grant. Do you see this? So you have to take a look. Oh, I've been given the plan by the government. What is the favor of this plan? You do that. If you cannot determine the favor of that, you cannot determine it all. Then there's no way. That's what I say. Alternatively, both may be valued at a nominal amount. Don't worry, we'll see about this. We'll see about this. No, don't worry about this.
Just one thing, Freddie, this non-monetary asset piece of land is monetary, right?
The piece of land.
Piece
mm,
of land is monetary asset, not non-monetary
No,
asset.
not mandatory. When something, let me simplify matters for you. To call something mandatory in a simple manner, under this standard here, is if you have a piece of land, let's say that you have a piece of land, is someone obliged to pay you something? It's simply because you have a piece of land. You have a
Yeah.
piece of land. You have a piece of land. Is someone obliged to pay you just because you have a piece of land? I need to hear from you. You have a piece of land, but having a piece of
Yeah.
land doesn't mean someone has to pay you, right? But by calling it
Yeah.
monetary asset, it's like you have created an obligation to someone, right? By creating, for example, trade receivable. If I say trade receivable, that means I've already done my part. I've sold something to you. I expect you to
Yeah,
pay
trade
me.
receivable will be non-monetary asset. But all that I'm saying it in this paragraph, it's saying the non-monetary asset shall be transferred by the government to an entity as a grant. For
Yes,
example, a piece of land. This is not the right example.
this is not the right example. No, it is the right example because it is a non-monetary asset. Listen, land is a non-monetary asset. I don't know if you got me. Land is a non-monetary asset because if you have land, let listen. If you call something monetary asset, don't look at what you can generate. Look at if someone have has does someone have an obligation to pay you? Okay, you have land. You have land with you. Does someone have an obligation to pay you just because you have land? No, right?
We can rent out that land. We can rent out the land.
If you do rent it out, you can say that if you rent it out. For example, if you say that I have invested in property, I've rented it out to someone, then you can call no problem, you can call it monetary asset because you expect someone to pay you. Someone has an obligation to pay you. But in this case here,
Okay.
it's not like that, right? Maybe you have given someone a loan. If you give a loan to someone, that means someone has an obligation to pay you. So look at the other party. Do they have an obligation to pay you or not? And then you can decide, right? Don't worry about this. We'll take a look toward this other standard. Okay? And say, let's finalize here. Accounting approaches now. Now, for these accounting approaches, it's not much. We have the capital approach, but also we have the income approach. For capital approach, I've just written it here, but we do not use it. We use the income approach. As I told you that income has to be matched with the cost. We spoke about this here. We said that income has to be matched with the what? With the cost. And do not take that directly to equity as capital. If you take it to equity directly, it's like capital. So that's what we're trying to speak of here. So we have capital approach, but usually we do not use it, right? I'm just writing here, but we won't use this. We'll use the income approach. The grant is credited directly to shareholders' interest to equity, something which we reject, which we actually stop. We just say that do not use that. Okay, there are some people who say that, oh, this approach is fine. I'm repeating again, we are not using this for government grants. But let's say, why do they say that this is fine? They say that grants are a financing device. Something that goes to equity is actually acts as a source of funds. So they say that grant is a financing device. So they should go directly to the balance sheet under equity directly. Right. And they said that in the income statement, they should only offset expenses with their financing as and when required. So they say that, oh, it's a financing device, so it goes to equity. But we say that, oh, this is not right. This is not right at all. Right. So you have to know that. But the income approach says that grant is credited to income statement over one or more periods. Simply speaking, you recognize income and you match it with the cost. So the arguments here say that grants are not received from shareholders. So since they're not received from shareholders, they should not go to equity, as this one said here, the financing device. Another argument for the capital approach is no repayment is expected by the government. So the grants should be credited directly to the shareholders' interest. You know, when you have the share capital is not repaid, right? If
Mm.
you buy shares in a certain company, they will not pay you back. You can actually sell that to another shareholder, but they will not pay you back your money, right? So that's why we say, since the government does not expect repayment, we say that it should go to equity. That's the what they come with, right? But also here and the income approach, there's an argument that says that grants are earned. We say that no, if you earn something, we say that it should be reflected in the income statement. You know, revenue and income are always earned. If you earn, we say that we use the accrual basis in the income statement. Recognize revenue, recognize income when earned, recognize expenses when incurred. So grants are earned and they're not received for nothing. Here it looks like you just received something, you did not pay anything, right? But we are
Mm.
told here that they are earned not received for nothing. And so they are earned how? By compliance with conditions and by fulfilling the obligation. There are conditions you have to fulfill so as to have the grant. And that's why if you fail to fulfill the conditions, you have to repay those grants, right? But capital
Mm.
approach say that, oh, grants are not earned. Capital approach say, no, we not earn grants. They are just incentives without related costs. But we say this is not true because in reality, to receive the grant, you have to fulfill the conditions, and we mean those should be the costs actually. You have to
Mm.
follow those conditions. Okay. And the income approach to say that the grants are an extension of fiscal policy of the government, and so if income taxes and other taxes, just like you account for income taxes and the income statement, government grants to other forms of fiscal policies, and so they should also go to the income statement, right? So
Oh.
this is how we do, but not that we apply the income approach when dealing with the government grant. So that's what we will do now. I think time is almost going up. We have about 5 minutes to end this, and I need to go to. Let's do this.
Can we have a class tomorrow, same time?